Good evening, everybody. Welcome to the 6th annual Distinguished Morgan Stanley Lecture in Finance, the New Economics School. When we started the Masters in Finance program, conceived together with Morgan Stanley, we were very excited that the Masters in Finance program will have this annual event where we bring a distinguished finance academic from outside of Russia to give a talk on where the finance as a field, as a profession is going. We've been very fortunate to bring very distinguished finance academics. Just to give the list of those, the first lecture was delivered by Ken Fruit, then Bob Schiller came. Bob was advisor of John. Then we had Raghu Rajan giving the third lecture. Then we had Bob Engel, Nobel Prize winner, to give the fourth lecture. And last year we had John Cochrane, also a co-author of John Campbell, to give the last year's lecture. We think this is a very important part of the New Economics School's mission to introduce the students, but also the general community in Moscow to the frontier of economics research. And we're very excited to continue bringing the leading academics in the field. So now we also broadcast and tape this lecture. So for those of you who know that your friends couldn't come tonight, they will be able to watch our lecture on our channel in YouTube. Also, I would like to use this opportunity to mark two events. First, New Economics School is turning 20 this year, and we will celebrate the 20th anniversary in December. Please pick up the booklets in the hall, which tell you about this event. There will be a big international academic conference, but also other events to celebrate 20 years of NES. And then also, since it's an event related to Masters in Finance program, I use this opportunity to once again advertise this exciting program supported by Morgan Stanley and remind you that admissions are now open, so please tell your friends to apply, or if you are an applicant yourself, don't forget that the admissions are open, but then they'll be closed soon. So also pick up the materials in the lobby if you're interested in studying in this exciting program. With that, let me give floor for short remarks, short introductory remarks to Kenneth Levine, who is the head of equity sales and trading in Morgan Stanley. Morgan Stanley has been a very generous and committed partner with the New Economics School in this venture of building the Masters in Finance program here in Moscow, and also in supporting this annual lecture. Kenneth, please.
Здравствуйте. I just wanted to say hello and welcome everybody here. I want to keep this short as we're all here for the main event, courtesy of Mr. Campbell here. But I did want to reiterate what Sergey had said, is that we are very pleased and honored to be a part of the union with the New Economics School, and we hope that it can add some value into your lives going forward. As I said, I want to keep it short. I'll be around at the reception after if anybody would like to talk away from the room over here. So as I said, we'll move it on to John and go from there. Thank you.
Thank you very much, Ken. Let me say a few words about John. John Campbell, professor at Harvard, and actual chairman of the economics department at Harvard, does not need an introduction, and yet let me say a few words for you. Many of you probably watched the Inside Job documentary. John was featured, but this is not the most important contribution of John's to finance and economics. John has actually done important work in macroeconomics, in asset pricing, in fixed income securities, in portfolio choice. He's also written a very important textbook many of you have actually used, on econometrics of financial markets with Andy Lowe and Craig McKinley. This is a best-selling textbook. He was born in the UK. He graduated with the first-class bachelor's from Corpus Christi College at Oxford. Then he got his PhD from Yale. Then he was on the faculty of Princeton, got tenure at Princeton and moved to Harvard. And he's been at Harvard for 18 years now. At Harvard, he has received many important prizes, both for his excellent teaching at Harvard College, but also for his research in economics and finance profession. He was co-editor of the leading journals in the field. He's published about 80 articles in the leading journals, including more than 10 in Journal of Finance and I think 6 in QJE. Most importantly, he's contributed to many parts of macro and finance, and this is why it's so exciting to have him today to talk about the mortgage market, because in the mortgage market you have to know a lot of things. You have to understand urban economics, you have to understand asset pricing, you have to understand macro, and in all of those disciplines, John has actually made seminal contributions. John is not only an abstract academic, he's contributed to policy making and public debate in many capacities, but I think one very notable contribution was his participation in the Scone Lake report. Many of you have heard about this conference, and a book done a few years ago by a group of the key 15 academics in finance who actually laid the intellectual groundwork for redesign of financial regulation in the US and not only in the US during and after the recent financial crisis. And in that capacity, we see that John has turned many of his insights from his academic work into the impactful public debate. Today he will talk about mortgage market design, and we'll talk about both academic research, but also about very relevant market design stuff, which has implications for all of us. John, the floor is yours. Thank you very much for coming.
Okay. Well, Sergey, thank you for those kind words of introduction. If any of you did see Inside Job, you may be thinking that I will be very tongue-tied tonight, but I shall try not to be so incoherent, and I have the advantage that you will hear me unedited. I'm very grateful to be here in Moscow and to be participating in an event at NES, and very grateful for the sponsorship of Morgan Stanley. The topic I want to talk about tonight is the design of mortgage markets. And, I think for anybody interested in the financial system and the way in which it affects the well-being of ordinary households, mortgages are first order important. For the typical middle-class household in a typical country, the house or the apartment is the largest asset that the household has. And again, typically, the mortgage is the largest liability. Now, I understand that the situation in Russia is somewhat different because many people acquire the ownership of apartments outright and therefore don't yet have mortgages. But I think as we look into the future, as one generation gives way to the next, and the young generations buy real estate, that mortgages are going to become more important here too. And this may be an opportunity for Russia to look at other countries, learn from experiences of other countries, and design a system with good properties. Now, the interesting thing is that when you look across countries, mortgage markets vary very considerably from one country to the next. They're not all the same. And this should lead us to ask, why is that? What is causing the variation across countries? Is it differences in fundamental conditions, or is it simply historical accident combined with inertia? And then what are the consequences of these differences? Do some systems work better than others? We might ultimately hope to identify international best practices and then carry them from one country to another. And this is an example of a style of research that I think is gaining momentum these days, which I'll call international comparative household finance. Now, I just want to show you some figures to set the stage, which are taken from an IMF report from last year that systematically compares mortgage markets in different countries. So this first chart just shows the home ownership rate, which is the fraction of housing units that are owned by their occupants as opposed to being rented. And the red arrow here shows the US. Russia is not included here, but you'll see Russia in a subsequent figure. The point here is just to observe that the US is middle of the road. The highest home ownership rates tend to be in southern Europe. They may be influenced a little bit by the ownership of vacation homes by northern Europeans. The lowest home ownership rates tend to be in northern Europe, and particularly in Germany and surrounding countries. Now, here we see the amount of mortgage debt relative to GDP. And here again, Russia is not shown. Russian mortgage markets are, as I understand it, still trivially small relative to the GDP. Much larger in other countries. The US, again, middle of the road. The highest levels of mortgage debt are actually in northern Europe, and they're much lower in southern Europe. Now here is a respect in which the US is not at all middle of the road. And that is the predominance of fixed-rate mortgages. So when you take out a mortgage, the interest rate may adjust with market conditions, or it may be fixed, pre-specified. And in the US, long-term fixed-rate mortgages predominate. So what's shown on the vertical axis here is the number of years over which the interest rate is fixed, averaging across all the mortgages that exist. Now, in the US, you have about a 90% market share of 30-year fixed-rate mortgages. And so this blue bar for the US is up at 90% of 30, or about 27. That same is not true in Southern Europe or the UK, where the average fixed period is more like 1 year, 18 months, maybe 2 years. In Canada, it's about 5 years. The only European country that looks like the US is Denmark. This is Denmark here, and I'll have more to say about Denmark later on. Finally, let me just show this figure from the IMF report, which compares two things. On the horizontal axis, we have the home ownership rate, and on the vertical axis, we have an index of government involvement in mortgage markets. These are this index is constructed by the IMF using data on mortgage subsidies, tax preferences, the existence of government-owned banks or government-owned institutions that insure mortgages. And what we see here is that the US, although middle of the road in its home ownership rate, actually has a very interventionist government. Now, according to this index, the IMF index, the US is even more interventionist than Russia. Here we see Russia with also middle-of-the-road home ownership rate, but a less interventionist housing finance system than in the United States. Now, I've been speaking with Sergey about this. He's given me some comments, and he argues that this index for Russia may indeed be understated. But my main point is that the US the government has involved itself in the housing market to a considerable degree, often with the stated goal of increasing home ownership. Yet at the end of the day, the US has a somewhat average home ownership rate. So with that introduction, let me now try to provide some perspectives on mortgage markets. And I want to argue that to do this, we need to draw on many subfields of economics. It's not enough just to use standard textbook finance. We have to be broader than that. And where I want to start, in fact, is with urban economics, which is a field that thinks about the physical nature of housing as an asset. And from that argues that there may be externalities from home ownership and also from transfers of home ownership through foreclosures. That these processes may have external effects that aren't properly taken into account by market participants. That may then give you a justification for government involvement in the mortgage system. And it is very noticeable that most governments get very involved. Why is that? Why not let the free market work? Well, one reason may be to do with these externalities. So let me start with that. Then I'll talk about asset pricing. This part of finance thinks about financial contracts that share risk. And so mortgages share risk between borrowers and lenders and ultimate investors. And we want to know how those risks are shared. And we can also think of default, failing to pay the mortgage, as a way of shifting risk from one party to another. Now, classic asset pricing assumes that all agents are rational. That may be a mistake in the context of retail financial markets. It may indeed be a mistake in the context of institutional financial markets, but certainly when we're thinking about retail behavior. So I'm also going to draw on behavioral finance, which thinks about the heterogeneity of consumers, the differences across households, and raises the issue of whether we need consumer protection in mortgage markets to protect borrowers from making foolish mistakes. Now, of course, any mortgage system has to be funded. Somebody has to provide the money, and investors have to earn a return. So the question of how we fund the mortgage system is the subject of financial intermediation. And here we encounter issues of financial stability, maintaining the liquidity of the mortgage market. And having lived through the global financial crisis, we all can understand how important these issues are. And then finally, I want to bring in macroeconomics, because the form of the mortgage system has important consequences for monetary policy, and it connects with interesting issues in political economy. Ultimately, again, as we've learned, decisions about mortgage markets become very political. Now, all these fields have their own insights, but the trick is to put them together. It's like the story of the blind man and the elephant. Each of the fields is one of these blind men. They perceive part of the beast, the trunk, the tail, the ear, and so forth. But we don't understand the elephant until we integrate them. So that's what I'll try to do. The time is limited, but at least I'll give you a flavor for the endeavor, a feel for the endeavor. So I'm going to go through each of these 5 fields in turn. I've got 5 blind men. I'll work my way through and then try to put it together at the end. Okay, so first of all, urban economics. Now, as I mentioned, this field is big on the notion that there are externalities. And indeed, politicians are keen on the argument that home ownership has positive externalities. This is very popular in the US. The idea is if people own their own houses in a community, then they have the incentive to look after the community and take actions that they otherwise wouldn't, and which the community cannot directly pay for. Now, colleagues of mine, I have a colleague, Ed Glazer, a well-known urban economist, and he has made the opposite point, that in fact owner-occupied housing is very dispersed and energy-intensive, so it creates sprawl and environmental problems, which might push in the opposite direction. But still, the social goal of promoting home ownership has traditionally been important in the US and many other Western countries. Now, I want to make a slightly different point about housing, which is that houses are fragile assets that need a lot of maintenance and looking after. And since I own a suburban house in the US myself, I'm painfully aware of this at the individual level. Now, one reason why single-family housing is normally owner-occupied is that this aligns incentives. The owner is living in the house and has the incentive to look after it. The difficulty is that if the owner becomes financially distressed and is in debt to the bank, and the bank takes over ownership of the house, now the incentives are misaligned. And the evidence is that this can destroy value. So I have research on this that appeared in the American Economic Review last year, in which we showed that foreclosed houses sell for very much less than comparable houses, controlling for all the characteristics we know how to measure. I'll just show you some of the evidence. Our data come from Massachusetts. This is the state of Massachusetts. And the blood red color indicates the incidence of foreclosures and other distressed or forced sales. This won't mean much to you, but basically the dark red blocks on the map are either distressed urban areas, depressed towns, or poor rural areas. Wealthy suburbs like these ones here have fewer foreclosures. Now, the content of the study is an analysis of prices, and we use a method called hedonic regression, which essentially regresses house prices on characteristics that might influence the price, such as the size of the house, the size of the lot, the age of the house, and so forth, and also on variables that capture local variation in house prices from year to year. Then in addition, we put dummy variables for conditions of distressed sale. We look at death, bankruptcy, and foreclosure. And the big effect is that foreclosure, when a bank has taken over a house from a borrower and is selling it, that foreclosure results in a decline in the log price of 0.31, which is equivalent to a 27% discount on the price. Now, when you ask why this is, a clue comes from the fact that the effect is larger for cheap houses in bad neighborhoods. As I mentioned from the map, that's where most foreclosures do happen. But that effect is stronger in bad neighborhoods. And to us, this suggests that the mechanism is probably related to crime or vandalism, that these are the areas where houses are most easily damaged, and where costs to the bank of protecting the house, which may be fixed dollar costs, will be a larger fraction, a larger percentage of the value of that house. There's also some direct evidence by people like Brian Meltzer that you don't even need a foreclosure to have the value destruction. If a homeowner is financially distressed, they will stop maintaining the house. Now, so far, this doesn't count as an externality. That's just a loss on the house itself, which both the lender and the borrower will take into account when they make their contract. However, in the same paper, we find that neighboring houses are affected by foreclosures. So in order to show this, we have to try to control for local economic conditions, because if conditions are bad in an area, house prices fall, foreclosures happen. That's a correlation, but it doesn't mean that the foreclosures are causing the house price decline. So to control for local conditions, we use an index of foreclosures in a broad area, and then we have a local index of foreclosures in an immediate neighborhood. And we show that the highly local foreclosures have an additional effect. And our best estimate is that each foreclosure that happens in a narrow neighborhood, let's say at a distance of about 100 meters, this is on the order of 100 meters, that will reduce the price of a house by 1%. And this is an externality. It's not going to be taken into account by borrowers and lenders because it's affecting their neighbors. Here too we find the effect is worse in bad neighborhoods, and we find that it's long-lasting. The effect is still visible 2 years later after a foreclosure. When you ask what's going on, it's probably due to physical damage in the neighborhood and the encouragement of crime. And there is direct evidence that foreclosures are associated with increases in local crime. Now, what does this mean for mortgage policy? These kinds of results will give you an argument why public policy should try to reduce foreclosures. Because borrowers and lenders, when lenders use foreclosures as a way to protect their interests, they're not taking into account all the effects, the social broader effects of that policy. So as an example of a poor system, in the 1920s, a common form of mortgage in the US was a 5-year balloon mortgage. Balloon meaning no repayment until the due date. These mortgages required frequent refinancing. Every 5 years you'd have to roll over the debt. And that refinancing becomes impossible if times are hard and homeowners have reduced income, or if banks are in trouble and they stop lending. So, of course, when the Great Depression hit, one of the problems was people couldn't refinance their mortgage, and you had a wave of foreclosures, which then drove house prices down further and appears to have contributed to the severity of the Great Depression. So in response to that, the US shifted to long-term 30-year fixed-rate mortgages, which are more common today. And even those countries that have adjustable-rate mortgages will normally have long maturities and amortized payment of principal to avoid the need for frequent refinancing. Okay, so now let me turn to my second field. Let's talk about asset pricing. So the asset pricing perspective is that mortgage contracts share risk between borrowers and lenders. So long as the mortgages are long-term, then borrowers are protected against deteriorations in their own creditworthiness. So if you take out a mortgage, you're not like a financial institution that's in the repo market, let's say, where you could be asked to put up more collateral if conditions change. So long as you make your mortgage payments, nothing that happens to you is going to change the terms of the deal. Similarly, nothing that happens to your bank is going to change the terms of the deal. So credit market conditions don't affect borrowers. The remaining questions, though, concern the way in which changes in real interest rates, inflation, and house prices are going to be shared between borrowers and lenders. So to analyze that, let's start by assuming rational borrowers who don't default and don't move, and then we can think about default, moving, and very importantly, suboptimal behavior by borrowers. So what I want to do is compare fixed-rate mortgages and adjustable-rate mortgages. So fixed-rate mortgages, the common form in the US, stabilize the payments that borrowers have to make in nominal terms, but not in real terms, because they're not inflation adjusted. What that means is that borrowers win big if inflation increases. So the generation of people who bought houses in the 60s and 70s and then saw inflation increase, they did really well because inflation wiped out the value of their debt. So that's the upside for borrowers. The downside for borrowers is deflation, or lower than expected inflation, in a circumstance where either the mortgage has prepayment penalties or house prices fall to prevent refinancing. So this has happened in the US today. Many homeowners they want to refinance, but they can't because house prices have fallen, so they don't have the equity in their home that would be needed to make that possible. Now, of course, ex ante, the mortgage lender is going to charge for the balance of upside and downside risk. And if inflation is very volatile, then there's a lot of this risk, and to the extent that it's a one-sided risk, fixed-rate mortgages will become very expensive. Now, what about adjustable-rate mortgages? In many ways, these seem like ideal instruments because an adjustable rate mortgage it's a floating rate note. So it has a stable real value. If inflation changes, the nominal interest rate will adjust to compensate, and the real value of the floating rate note, the adjustable rate mortgage, will be unchanged. So that might at first seem like a safe instrument, and in principal value terms, in market value terms, it is. However, there are risks to the payments that borrowers have to make. If real interest rates go up, borrowers will have to pay more, period by period. The present value of the payments will be unchanged, but the payments themselves will go up. The second risk is that if inflation increases, then in effect what happens is that the nominal interest rate goes up and you have to pay more immediately. Now in the long run, your real payments will decline with inflation. So you could undo the effect by borrowing more, but if you're borrowing constrained, you won't be able to compensate. So I became very aware of this because I had friends that I went to college with in England who all took out mortgages in London in the late 1980s. And they stretched to buy the biggest houses they could. They took out a big mortgage, and then the government lost control of inflation. Interest rates went up, and their mortgage payments went up. And they couldn't borrow more to compensate because they'd already borrowed the maximum they could to buy their house, and the value of their house fell in this high interest rate environment. So they had to tighten their belts and consume less, but it was a painful experience. So adjustable rate mortgages have these risks to borrowers that need to be taken into account. Now, of course, the initial interest rate is typically lower because short-term rates are normally lower than long-term rates. What that means is that if you're borrowing constrained today, you typically prefer adjustable rate mortgages because it makes the house more affordable or enables you to afford a bigger house. However, the risk of future borrowing constraints, which is when this condition matters, the risk of future borrowing constraints will lead you to prefer fixed-rate mortgages. Now, so far I haven't mentioned default. You know, my friends in London in the 80s actually didn't default, they just tightened their belts. But default, you can think of default as a way in which a household can manage downside risk. Now, it's going to matter, of course, whether the mortgage lender has the right to pursue the borrower in the event of default. In most European countries, lenders have that right, and in about half of the US states that's possible, and the other half it's not. So that's going to be an issue. I'm going to talk here mostly about non-recourse mortgages, in which case the borrower can always put the house back to the bank and walk away from the debt. So then the question is, when do you want to do that? When do you want to default? And this is an interesting finance problem because it's an example of a real options problem. And these are technically quite difficult. You need to buy a book by Avinash Dixit in order to solve this problem. Yet this is a problem that we ask ordinary homeowners to solve. Well, the way to think of it is that there's going to be some level of negative home equity. By negative home equity, I mean that the value of the house is less than the value of the debt. So here's your debt, here's the value of the house. The value of the house falls. You don't default the moment the house is worth less than the debt. There's some threshold level at which you choose to default. Now, where is that level? The trigger level for default is going to depend on whether you're borrowing constrained today. Why? Because defaulting has immediate benefits. You no longer have to make those burdensome mortgage payments. On the other hand, the costs are longer run. You lose access to credit in the future. You're going to have to rent housing. That will be more expensive and less convenient. So you have immediate benefits, long-run costs. If you're borrowing constrained, you effectively discount the future at a high rate. What you care about is the immediate benefits. And so you will be more willing to default when you're borrowing constrained. So practitioners sometimes talk about this as the so-called dual trigger model of default, where basically you need, in order to default, you need negative home equity and a cash flow problem. I prefer to think of it as a single trigger whose position varies with your cash flow circumstances. So I have a paper that I'm working on now with Joao Cocco from London Business School, where we study this problem theoretically. And this is not real data on this figure. This is simulated data from our model, but it illustrates the point I'm making. So the horizontal axis here shows the extent to which you're underwater. So here you're 10% underwater. Here you're 20%, 30%, 40%, and so on. This is how much less the house is worth than the debt. The black line is the incidence of default. So you see some defaults, and then it really takes off here at about 35% underwater. That's where you get so-called strategic defaults, where people just walk away. Now, these bars, the red and grey bars, show you the ratio of mortgage payments to income. The red guys are the non-defaulters. The grey bar is the defaulters. So you can see that here in this region, defaulters they have a cash flow problem. The mortgage payments are eating up too much of their income, and that's why they default. Whereas over here, there's very little difference between the two bars, and this is saying that these defaults are caused simply by the fact that it makes sense financially to walk away if I have the right to do so. Now, this model, and I'm not going to go into the details, but the model implies that, in fact, the overall default rate is going to be comparable for fixed-rate mortgages and adjustable-rate mortgages. So it's not that one of these two types of mortgages is fundamentally more risky than the other. They both have similar default rates, but those defaults occur in different circumstances. So fixed-rate mortgages tend to default when inflation and interest rates are low, because then essentially the cost of renting is low relative to the cost of staying in the house. Whereas adjustable rate mortgages tend to default when inflation and interest rates are high, because that's when required payments go up. So what do we learn from this? Well, the US has a fixed rate mortgage system. And in the US, we have the luxury of being able to lower short rates very dramatically. Interest rates are very low in the United States today. Ironically, that doesn't help homeowners much, because we have a fixed rate mortgage system. And homeowners are prevented from refinancing by the low level of house prices. So the US today would probably be better off with an adjustable rate system. On the other hand, an adjustable rate system will generate a wave of defaults if interest rates and inflation spike up. For example, if there's a currency crisis. So I'm going to show you here data from Britain. This is bankruptcies in England and Wales. Now, Britain has a adjustable rate system. Now, so the green line is the incidence of bankruptcies. Think of this as a proxy for the mortgage defaults. You can see a big spike here. This is recent events. And you can see how interest rates are very low, inflation is low, but of course house prices have collapsed. So we have defaults. But then you also see a spike back here in the late 80s, early 90s. Now this is the story I was telling you about my college friends in London when they first bought houses. They bought houses around here, and then inflation got out of control. The nominal interest rate had to go way up. Britain was trying to stay in the exchange rate mechanism, and the result was a wave of bankruptcies. Okay, so this would not have happened if Britain had had a fixed rate mortgage system. Now, in Russia, my understanding is mortgages are primarily fixed rate. However, before the crisis, foreign currency mortgages were quite popular. So these tend to be popular in countries that have high domestic interest rates. So they've also been used in Poland, in Hungary, in Iceland, and a number of other countries. So here's the fraction of outstanding Russian mortgages denominated in foreign currency. In the mid-2000s, that was above 50%. It's been declining, essentially because new foreign currency mortgages people have not continued the practice. But why have they not continued the practice? People have figured out that this is very risky if there's a currency movement, a big currency movement. And of course there was during the financial crisis. The US dollar appreciated relative to the ruble very dramatically. So, the result is, here we have the delinquency rate, the rate at which mortgages fall behind on their payments. And the green line shows foreign-denominated mortgages, foreign currency mortgages, and these have gone delinquent at a much higher rate than ruble-denominated mortgages. Why? Because they've become very expensive. They're very risky. Okay, so that's asset pricing. Now, so far I've talked about rational models of risk sharing, but behavioral finance thinks about the possibility that people make mistakes or need help in some way. Now, I'm going to focus on two issues. One is financial sophistication, and the other is so-called present biased preferences, which is essentially being impatient, being subject to temptation when opportunities arise to spend money. So financial sophistication is a real issue in mortgage markets. These are very complex markets and difficult for people to manage. So just some evidence. There's a paper by Susan Woodward which shows that if borrowers are presented with a complex menu of choices, they will often pay excessive fees. They'll get confused, they'll end up paying too much. There's a paper by Brian Bucks and Karen Pence that shows that many borrowers don't understand the terms of their mortgages. What they do is they survey adjustable rate mortgage borrowers and they ask them, how much could your rate change? And they get a distribution of answers. Then they go to the banks and they ask the banks, for the mortgages you've issued, how much could the rates change? And the two distributions don't match. People think that their rates can't move much, but the banks say, yes, they could move a lot. So this study doesn't say that any specific borrower is confused, but the whole group of borrowers collectively appear to be confused. Finally, there's interesting evidence that many borrowers don't manage the prepayment option efficiently. Well, that's probably not surprising. I said it was a difficult real options problem, and I'm writing a paper where I'm solving this problem numerically. Maybe it's a tall order for people to get it right. But people make what seem to be obvious mistakes. So Miles' report was an interesting study in the UK of their adjustable mortgage system, which pointed out that in 2004, a year of a strong economy and rising house prices, a third of the population seemed to be paying a rate that was higher than they needed to pay. And then I showed a similar thing for the US in a paper called Household Finance from 2006. Now this is interesting because this confusion by homeowners creates uncertainty in lenders about when people are going to prepay mortgages. And this has been a major source of employment over the years for sophisticated finance professionals, perhaps such as yourselves, to model and manage this prepayment risk. Where does that risk come from? It comes from the fact that we've given borrowers a complex instrument that they don't know how to manage. So, I find this very ironic that we've set up the mortgage system to create an artificial source of risk, and that we then have to devote scarce resources to managing. There's also the possibility that in this situation, because some people fail to refinance optimally, they provide excess profits to the lenders. But the lending market is competitive, of course. Banks are competing with one another. So they'll either waste those profits in marketing costs, or they'll lower the rates so that sophisticated borrowers benefit from getting a cheap rate. In effect, they get a cross-subsidy from their more naive colleagues. So Xavier Gabex and David Leibson have pointed out that in this situation, it may be impossible to have financial innovation towards simpler products. Why? Because imagine a bank that wants to market, let's say, an automatically refinancing mortgage. Sounds like a great idea, right? It will avoid the mistakes, it will save on transactions costs, be very efficient. The bank tries to market it to consumers. Naive consumers, who are the ones who would benefit, they don't understand the product, so you can't market to them. Sophisticated consumers will understand the product, but they'll also understand that it's more expensive for them, because if they take the new product, they will lose the benefit of cross-subsidy that they enjoy with the existing product. And even if you try to educate a naive consumer into becoming a sophisticated consumer, that won't work either, because the newly sophisticated consumer will understand that the cross-subsidy is valuable. So this sort of equilibrium gives you an argument for a consumer protection agency like the new Consumer Financial Protection Bureau in the US, which can perhaps regulate the mortgage system and promote constructive innovation to reduce cross-subsidies. Now, a second behavioral topic is so-called present bias preferences. So this is the idea that when people think about the future, the distant future, they plan rationally and they plan to save. But when the distant future becomes the present and temptation appears, they consume more than they would have wished to before. Now, a very direct consequence would be that if we increase mortgage credit availability, that can encourage overconsumption. And this is a popular argument that's been made about the damage done during the credit boom, is that we lent people too much money and they consume too much. That popular argument has to rely on the idea that people don't manage their own affairs correctly, as will be the case if they have these type of preferences. A more sophisticated argument is that if borrowers are subject to temptation but also have inertia, then a system that rationally rewards refinancing to reduce the interest rate will go wrong, because when people refinance to lower their rate, they will also extract home equity. They will take cash out of their house and overconsume. So Andy Lowe and Bob Merton, two very well-known finance economists, have made this case. And they call it the ratchet effect. And they argue that this contributed to overspending during the credit boom. Now, all of this, I think, can help us understand what went wrong with the US mortgage market and many European mortgage markets during the 2000s. So during this period, new types of adjustable rate mortgages were introduced that had very low required payments initially, both low interest rates and low required payments. And then a couple of years into the mortgage, the required payments go up, you start to repay principal, and also the interest rate goes up. Now, what is the justification for the interest rate increase? Well, there's a perfectly legitimate argument for this structure, which is that borrowers who are creditworthy at the end of the initial period will refinance. That will mean that only the less creditworthy borrowers will stay with the mortgage. They're the only ones who will pay the penalty rates, and because they're less creditworthy, they should pay high rates. That's needed to compensate the lender for the credit risk. So what's wrong with that? Well, there are three arguments. The first two are behavioral, and the third is a more general one, which refers back to the externalities that I was starting with. So the first argument is just that the low initial rates may encourage borrowers to consume too much. This is a very paternalistic behavioral argument. The second argument is that there may be naive borrowers who won't refinance optimally. They'll end up paying too much, and they will cross-subsidize sophisticated borrowers. This is the argument that David Miles made in this report in 2004 about the UK system. But I think the third argument is actually the most important one, and this does not rely on the notion that borrowers are irrational, although they may be. This is just the point that this type of mortgage requires refinancing at the reset date. It assumes that that refinancing will occur. So if house prices fall and banks become reluctant to lend money, then the refinancing is blocked, and then you will get foreclosures. So what happened in the last decade is effectively that we reinvented the short-term balloon mortgages that were prevalent in the US in the 1920s. And then, having done that, we rediscovered the problem with the original mortgages, which is that they require refinancing. And they will generate a wave of foreclosures if refinancing is impossible. So even with rational borrowers and lenders, I think there's a good argument to have public policy prohibit these mortgages or severely restrict their use because of the external effect of foreclosure waves. Okay, now let me turn to my last two fields. Let me talk about the funding of the mortgage system, and then bring in some macroeconomics, and then we can conclude. So obviously mortgages must be funded. Somebody has to come up with the money. And whatever risks the borrowers are protected from, those risks are going to be borne by somebody else. Either the originators, the original people who lend the money, or investors who buy the mortgages from the originators, or possibly guarantee providers, insurers who will provide certain in effect, insurance against risks. And to understand the mortgage system, we have to know who's going to bear these risks. Different systems allocate different types of risks differently. Now, risk allocation is going to matter. It's obviously going to affect pricing, because lenders are going to charge a market price for the risks they have to bear. It'll also affect the incentives that originators have to underwrite the mortgages correctly, in other words, to judge credit risk accurately. And that in turn will influence the risks that get into the system in the first place. If you design a bad system, you'll end up with a lot of bad mortgages, and you'll see the effects of that in a crisis. Once a downturn occurs, it may be optimal to modify loans. Again, given the costliness of foreclosures, it may be optimal to cut a deal with a borrower to change the terms of the loan, to modify the loan. The risk allocation is going to influence the incentives that mortgage servicers have to do that. So there's three basic funding systems that I want to contrast. Deposit-financed mortgage lending, which is the old-time traditional system. Securitization, which is the modern system in the US and the UK. And covered bonds, which are widely used in the rest of Europe. And I actually want to argue that covered bond systems have advantages that the US should consider, and maybe that Russia should consider as you develop your mortgage system. So with deposit-financed lending, originators retain all the risks. They make the loans, they keep the loans on their books, they're on the hook if the mortgage goes bad. That means that, at least at the beginning, incentives are aligned. The originators have all the incentives they would need to originate mortgages carefully, and if it's appropriate, if it's in their interest, to modify the loan. What are the problems with that? Well, First of all, mortgage supply is limited by the availability of deposit funding. So there's a danger of running out of the deposits that make the system go. Secondly, this system involves liquidity transformation. The deposits are liquid, the mortgages are not, so the bank is vulnerable to a run. The most dramatic example of that in the financial crisis was the UK bank Northern Rock. It didn't really have maturity transformation because it was holding adjustable rate mortgages and paying adjustable deposit rates. Everything was matched, but the mortgages were illiquid. Now, in the fixed rate mortgage systems like the US, we also have maturity transformation. So the mortgages then are long-term bonds, the deposits are short-term, and so the originators are exposed to interest rate risk. Famously, in the 70s and 80s, when interest rates went up, mortgage lenders, savings and loan institutions in the US, became insolvent because they lost money on their long-term mortgages. Once originators lose money, then you get a classic debt overhang problem from corporate finance. And the originators may have the incentive to try to gamble their way out of trouble. And so, in effect, you have a misaligned incentive problem. All right, so in the wake of the debacle in the 70s and 80s, the US shifted to a securitized system in which originators don't keep the mortgages on their books. They pool them, and then they create securities based on those pools. Now that, in order to work, that typically involves some public credit guarantees. So in the US, the government-sponsored entities, Fannie Mae and Freddie Mac, used their government sponsorship to provide insurance that was very reassuring to investors. The end investors are left with the interest rate risk and the prepayment risk, and whatever credit risk has not been publicly guaranteed. And this means that then mortgages are liquid assets that can be funded by global capital markets. So most people were pretty pleased with this system until about 2006 or 7 when the cracks began to appear. What can go wrong? Well, one problem is that if end investors are ignorant and fail to understand they're ignorant, or if the credit guarantees are mispriced, then originators no longer have the incentives to underwrite carefully. They'll make bad loans and pass them off to gullible investors. Now, I think the big issue here is indeed the public credit guarantees. These are very hard to price properly, and they're vulnerable to political pressure, political distortion. So then you can get a problem where the private gains social losses problem, whereby the taxpayer is in effect providing cheap insurance, and the private sector no longer has the incentives to run the system correctly. Now, it's also true that in the crisis we learned that originators actually often held mortgage-backed securities, in part as part of the inventory of the securitization process, and in part perhaps for capital arbitrage reasons, that capital regulation encouraged the ownership of mortgage-backed securities. Well, that just recreates the problems of deposit-financed lending, because now there's maturity transformation, liquidity transformation, and so forth. Once a downturn begins, we get further problems within the securitized system. We can have capital flight if the public credit guarantees aren't fully credible or explicit. So this is what brought down Fannie Mae and Freddie Mac. They had to be taken over by the US Treasury because until that moment, the guarantee was not fully explicit. And then finally, there's concern that originators don't have the proper incentives to modify loans in a securitized system because they have the job of servicing the loans, but other people actually own the mortgages. So the modification will be costly to the servicer, but the benefits will go to somebody else. So these are all serious problems with the securitized system, and frankly at this moment the US system is broken in the sense that it functions only with an extremely high level of government involvement, which I think politicians from both parties and all economists agree is not sustainable in the long run. We have to find a way to extract the government from the system. So what about the third system of covered bonds common in Europe? Well, in this system, the originators retain the credit risk and they transfer the other risks. So what is a covered bond? It is a claim on a bank, on an originator, that is collateralized by a pool of mortgages. So the investor gets a double protection. You have a claim on the bank and you also have this collateral. Importantly, the originator, the bank, has to top up the pool of mortgages any time one of them defaults. So, in other words, as long as the bank is in business, mortgage defaults still create problems for the bank, not for the investor. And if the bank goes under suddenly, then you still have the pool of mortgages, which has been topped up until that point. So the risk is only the risk of a double failure, which of course in a big enough financial crisis can occur, where the mortgages collapse in value and the bank fails at the same moment. So in this system, the originators still are exposed to credit risk. If mortgages are defaulting, they will be responsible. So they have all the correct incentives for underwriting and loan modification. However, in other respects, the system has the advantages of securitization, that long-term capital is employed from elsewhere in the financial system to fund mortgages. And my reading of the evidence is that this system can be very stable and effective so long as it's managed to limit maturity transformation. If you don't limit maturity transformation, then you can have bank failures when interest rates go up, and at the same time you can get defaults and the system can break down. Now, I should mention that both a securitized system and a covered bond system requires liquidity. You need to be able to trade these covered bonds or these mortgage-backed securities. So in order to maintain liquidity, theory tells us, and I think common sense as well, that you need to minimize information asymmetries. So you can do that in all kinds of ways. I mean, credit guarantees is one way, but it has problems. But there are simple things you can do. You can make sure that the pools of mortgages are very large and diversified, so that any kind of special features of particular borrowers are fully washed out. And you can also design the mortgages to limit the effects of behavioral quirks, differences between sophisticated and unsophisticated, or demographic characteristics. And these design features are pretty important. Okay, now my final blind man is macroeconomics. I don't have too much to say about this, but I just want to point out that mortgages and monetary policy are very closely related. So let's compare a fixed rate mortgage system, an adjustable rate mortgage system, and a system with foreign currency mortgages like the one that Russia has had. So in a fixed system, if you have maturity transformation, the central bank may be inhibited from raising interest rates because it doesn't want to destabilize the banks. And this was a problem in the US in the 1970s. On the other hand, in an adjustable rate mortgage system, when the central bank raises interest rates, every homeowner, that means every voter, pays more this month. That means monetary policy becomes very political, as it has been in the UK, for example. Finally, in a system with a lot of foreign currency mortgages, if you have a currency crisis, if you have a big depreciation of the domestic currency, you're going to get a wave of mortgage defaults, and that will worsen the impact of the currency crisis. Now, what determines whether a country will have adjustable rate mortgages or fixed rate mortgages. One very important factor is the history of inflation. If inflation has historically been volatile, and the citizens don't trust the country to keep it stable, then nominal fixed rate mortgages become very expensive. They're too risky for lenders and hence too expensive for borrowers. Well, that's a simple point, but it turns out to explain a lot of the variation in mortgage systems. So in this figure, on the horizontal axis, I've got inflation volatility. Now, I'm using the pre-Euro period because a lot of these countries are Eurozone members. So I want to use pre-Euro data of inflation volatility. And then on the horizontal axis, on the vertical axis, I have the share of adjustable rate mortgages. And you can see that the southern European countries which use adjustable rate mortgages have had very volatile inflation historically. Whereas Germany here is at the opposite extreme. Now, I don't want to claim that this regression here has an R-squared of 45%. There's a lot of other things going on. You can't explain the difference between the US and Canada with this story. But I think certainly within Europe, this is clearly an important factor. Okay, well, let me now conclude, and then we can have some questions and comments. I'm going to conclude with a slightly US-centric set of ideas, because that's what I know the most about. Let me ask what will happen to the US mortgage system, and let me ask what should happen. Those aren't quite the same thing, alas. I guess I'd say first that I think the arguments for public policy to subsidize mortgage borrowing in general, and fixed-rate mortgages in particular, have been overstated. Not only is the case for home ownership overstated, but also subsidizing mortgage debt is a dangerous way to promote home ownership. It's not particularly effective, and it encourages the overaccumulation of debt. Having said that, I think that US borrowers are strongly attached to long-term fixed-rate mortgages without prepayment penalties. Some other countries use prepayment penalties, but I think in an American context, these would be thought of as un-American. You should always have the right to move. And I think this system is going to survive unless Ben Bernanke loses control of inflation and we get a Southern European experience, in which case fixed-rate mortgages will become too expensive. But short of that, which I don't expect to see, I think we will continue with fixed-rate mortgages. Now this raises the question, the challenge of how we fund these mortgages. We really have to reduce the reliance on public funding, at a minimum by trying to figure out a way to wind down the large holdings of mortgages in the directly held portfolios of the GSEs, Fannie Mae and Freddie Mac. So how can we restore the private funding of mortgages? This is not an easy thing to do. Let me suggest that we might try to learn from one particular European country, which is Denmark. Denmark is most like the US in that it has historically had primarily fixed-rate mortgages without prepayment penalties. Now, they are now shifting in the direction of adjustable-rate mortgages, but historically they've had fixed-rate mortgages. And their model has a number of appealing features. They use covered bonds without maturity transformation. And so despite the fact that they've had a major housing downturn, their financial system has been quite stable. The covered bonds have not defaulted. They have a clever design feature, which is that homeowners, in effect, can prepay at either face value or market value. So, if let's say interest rates rise, or there's a financial panic, and rates go up, bond prices fall, homeowners are not locked in. They can just go into the market and buy one of these cheap mortgage bonds and give it to the bank that lent them the money, and then they're all square. This actually means that homeowners, in effect, can supply liquidity in a crisis. Just the way companies can buy back their shares in a crisis, homeowners can buy back their mortgage bonds if they become undervalued. The Danes also use large homogeneous mortgage pools, which maintains liquidity. And then they do simple traditional things like regulating strictly, imposing conservative underwriting. They also have recourse mortgages, which reduces defaults. And through all of these means, they've managed to avoid public credit guarantees. Now, I would say that at this point, we need to experiment in the US. The US has had very limited experience with covered bonds. Actually, Washington Mutual, WAMU, one of the large US mortgage lenders, did issue covered bonds. WAMU then went bankrupt, but the covered bonds paid off in full, so they performed exactly as promised. Despite that good experience, there's opposition to the use of these bonds by some regulators in the US, which I think is short-sighted. I would say that we're in a situation where we ought to experiment, first of all with covered bonds, secondly with other design features of the Danish system that we can adapt to our securitized model. Maybe we want to stay with a securitized system, but there are other aspects of the Danish model that could be adapted to that. And thirdly, there's also a need to try to promote mortgage modification. And that's been the subject of a lot of government policy, most of which has been quite ineffective up to this point. Now, I don't want to imply, though, that any system I've discussed is the absolute best possible system. And economists have mentioned a number of innovations that could be considered in the future. For example, one could have automatically refinancing fixed-rate mortgages. Those would save a lot of transactions costs, which we now, and mistakes, which we now get by requiring consumers to manually refinance. We could have inflation-indexed fixed-rate mortgages, provided you have a credible price index and an inflation-indexed bond market. It might make sense to inflation-indexed mortgages as well. Bob Schiller, who, as Sergey mentioned, was my thesis advisor, Bob has proposed mortgages whose principal value is linked to indexes of house prices. This effectively means that homeowners take some of the house price risk and they transfer it to lenders, while still having all the incentives required to get them to maintain their own houses. Now, none of these yet exist. They've not come in, they've not spread, and there may be good reasons why they don't exist, but I don't think we should give up on them just yet. And I'll conclude by saying that both finance economists and consumer finance regulators should keep in mind that we may have a social role to perform in promoting helpful financial innovation in mortgages and other aspects of consumer credit. And it could even be that a country that has a relatively small mortgage market and a relatively undeveloped mortgage market is well placed to consider some of these innovations. And if you like, leapfrog the markets that I've been discussing today. So I'll leave you with that thought and then invite comments and questions.
When you have time for questions, please raise your hand and we'll get you a mic. Let me quickly respond to the leapfrogging issue. There is a reason why the mortgage market is not developed in Russia. Some financial instruments are protected. There is no credible price index, there is no home price index, so there are challenges which still need to be addressed. Yes.
Dr. Campbell, thank you for the exciting lecture. I have a question regarding your Danish alternative, particularly political economy or conservative underwriting. Do you think that conservative underwriting is politically feasible given that that affordable home ownership hits mainstream politics as a powerful political selling point, and the government has all the incentives for the political survival to promote like screening and subsidizing of these. Thanks.
Okay, so I think you're raising the question of whether it's realistic to expect conservative underwriting when politicians have an incentive to direct credit to less advantaged parts of the population in order to promote home ownership. That's a perfectly reasonable concern. This is part of how we got into the financial crisis, is through exactly that political dynamic. But I think politicians are certainly much more aware of the potential costs of overdoing that policy for the stability of the financial system and of the economy as a whole. They're keen to avoid blame for future crises at this point. So I think we're in a better position to get back to sensible standards. What I would also say is that I think that the benefits of home ownership can be overstated for lower income people in the following sense, that if we assume that you're not going to default, home ownership has costs that need to be taken into account. For example, mobility is much more expensive if you're owning a house. Given the very high transactions costs of buying and selling houses, which in the US is on the order of 6% just in real estate commissions, it's extremely expensive to move once you own a house. Now, lower income people often have more turnover of jobs and they may have more need to move. So it's not clear that you do that part of the population a favor by subsidizing home ownership. Perhaps it would be better to promote affordable rental housing.
And for lower income people, the transaction costs of real estate ownership and real estate transactions is a higher share of their income.
There's a higher share of their income, absolutely.
Yeah, there is a question.
John, thank you very much for good lectures. Константин Иванович, хотелось бы спросить, сможете ли вы дать определение современного капитализма? И в связи с этим, есть ли в соответствии с этим определением капитализм в Америке? И какой процент населения семей в Америке живет в собственных оплаченных домах, а какой процент в неоплаченных или в коллективных? Thank you very much.
Okay, well, there's a very large question and then a very specific question. So the large question, what's the definition of capitalism? And then, is there any capitalism in the US? I mean, but that relates very closely to the topic of my lecture and the concerns that many economists have in the wake of the financial crisis. If we have a system that relies critically on public guarantees to function, in what sense is that a capitalist system? And furthermore, if we distort private incentives by providing guarantees that aren't properly priced, are we setting up an unstable mix of an inherently unstable form of capitalism? I think on the slide I said private gains, social losses. If I'm a banker and I take risks and I know I'm going to be bailed out, that's not going to be a stable form of capitalism. So, really the big question facing the US and all other developed economies today is how do we manage capitalism to deal with to deal with externalities, to deal with consumer mistakes. These are traditional concerns, but also how do we limit the damage that public subsidies can do if they're not properly priced. And I think the answer is that you have to have a mix of regulation on the one hand and market pricing of credit guarantees on the other. And you have to try to design a system that will rely as little as possible on these public credit guarantees. That to me is part of the appeal of the Danish system. It's a way to get back to a purer form of capitalism, albeit with regulation as well. So I'm not calling for removal of regulation in this area. Now then, your specific question about home ownership in the United States is what is this?
We need to show slides back.
But
the question was not only home ownership, but also home ownership for those who prepay their mortgages.
I may have misunderstood the question. I'm sorry.
The question was which share of U.S. households have actually repaid their mortgages and are 100% equity? 100% equity.
Well, I see. So this is the overall home ownership rate. Yes, I mean, traditionally that was something that people aspired to in middle age, and one of the changes in the credit boom was that people kept refinancing their mortgage to avoid repaying the principal. In effect, they were taking money out as house prices rose, so that when the crisis hit, they still had a lot of debt in the house. I'm not sure what fraction of the population own their houses completely debt-free. That would tend to be more retired people, I would say. That would be the typical group that's in that position.
Thank you. Another question.
Thank you. And I have a quick comment and a question. First of all, from everything you're saying, it's quite evident that the current crisis we have is not the crisis of the free market; it's the crisis of the government, which was trying to manage the free market. So that's the comment. And the question is, on your externalities, you say that the fact that prices go down when the houses are foreclosed is a negative externality. Why do you think it's a negative externality? Because somebody sells the house at a discounted price, which is obviously whatever. It's a negative thing for him. But for me, for example, as a young professional, if I can buy a house with 7% discount, it's great. So it's actually a positive. So somebody else is going to benefit from it.
Yes, that's an extremely important point, which I should have been clear about. So you're right. A pure price change of a good that is unchanged in nature, sometimes people call that a pecuniary externality, but we normally don't worry about that because, as you say, one side to the deal gains, one loses, and in a complete market, those gains and losses will cancel out, and in general, we don't know which way it's going to go. I think, though, that the evidence is that these price effects are proxying for quality changes in the house itself. In other words, if it's physical damage to either the amenities, either to the quality of the house or to the amenities of the neighborhood, then that's a change in the quality of the good. So that's a traditional externality in which the seller loses through a lower price, the buyer loses because the buyer is no longer getting a good of the same quality. So the buyer does not gain what the seller loses. So that's the case you have to make in order to be concerned about this externality.
So the fall in price is not because of crisis, pecuniary externality, but indeed the true drop in quality.
True drop in quality.
Vandalism, it's bad. There is a question. Yeah, there is a question out there.
Dr. Campbell, at the beginning of the lecture, you showed a graph that displayed the government intervention into mortgage markets.
Yeah.
And you showed that the U.S. had pretty high levels. And my question is whether it's related to the population awareness itself. So the higher awareness of the population is the less intervention of the government, therefore we need a different possibility.
I'm not sure what you mean by awareness exactly.
Like sophistication.
Well, traditionally, the U.S. has liked to think of its citizens as sophisticated, although I think the evidence is mixed, shall we say. But, I think you could say, here's a bunch of countries, all in the sort of middle of the figure. You've got the U.S., Canada, Australia, the UK. There's a bunch of English-speaking countries with fairly comparable on many social indicators. And they vary enormously in the level of intervention. The UK, much less so. The US, much more so. I think it would be hard to argue that the populations of these countries are so different that it would explain this difference.
But then, like Germany, for example, Netherlands, and Czech Republic.
Here's another example. Germany and the Netherlands. Both fairly low home ownership rates, very similar cultures, socially very similar. Germany non-interventionist, the Netherlands much more so. So I think, there may be fundamental causes of this, and I think it would be extremely interesting to study those. It's a fascinating question in political economy, but I just think there's a puzzle because the countries at the top don't fall in an obvious grouping, and the ones at the bottom don't fall in an obvious grouping. So we're going to have to do some research to figure out what's going on here.
Yeah, I think this is a fascinating topic for research for people sitting here. Political economy of government intervention. That is a question.
Thank you. I wonder about the tax policy when related to home ownership. Correct me if I'm wrong, but I believe that in the US, the mortgage interest payment is tax deductible, whereas the rent is not.
Yes.
Do you know if that's the case for the other countries on your graph? And do you argue in favor or against it? Because that has both efficiency and distributional consequences.
Thank you. Yes. That actually is one of the elements of the IMF index that's plotted here on the vertical axis. The IMF report explains what their index is and breaks it into elements. And so they have a table in there which shows you exactly which countries have tax deductibility of mortgage interest. And the answer is some do, most don't. The US certainly does. And then your second question was, is this a good thing? And I would say no. It's not. Most economists who think about tax reform in the US argue that we ought to broaden the base, eliminate deductions, lower the rate, and that would get us a more efficient tax system. And number one on the list, the economists' hit list of distorting deductions is the mortgage interest deduction. And the problem is it's politically very popular.
Hi, that was a wonderful talk. One of the things that you mentioned at the beginning was that foreclosures represent an additional drag on housing prices, even around the houses around the foreclosed house.
Yes.
And that this is, of course, bad for the economy sort of going forward. And then the rest of the talk was about sort of how to design better systems. So what would you say is the proper sort of public policy response for the U.S. government or any of these governments facing sort of housing crises to get the current homeowners sort of out of trouble now without creating some sort of further sort of moral hazard issue?
Okay, thank you. That's a very good That's a very good question, because you might think, well, if foreclosures are, suppose you buy the argument that foreclosures are damaging, you might say we must stop the foreclosure process. But it's not clear that's the optimal thing to do, because if the problems are being caused by the misalignment of incentives during the period in which the distressed homeowner is no longer able to pay, no longer confident that they're in the end going to own the house, then if you end up slowing down foreclosures, you may do more harm than good. And this is an argument that Paul Willen at the Boston Fed has been making. And Bob Hall at Stanford also has this view. Is sort of that, if there's no alternative, you want to get the foreclosure over with quickly. To reduce the length of time during which incentives are misaligned. On the other hand, I think it's clear that there are cases where modification is actually in the interest of the lender and borrower privately. And then there's a question of whether the dispersed, the separation of mortgage servicing and ownership of the mortgage is creating frictions which are reducing the rate of mortgage modification. And in that case, you might have a situation where you can avoid foreclosure altogether by restructuring the loan, solve the incentive problem, and still save the bank money. And that's trading off the very large 27% discount that I mentioned, the private discount on the foreclosed house.
Okay, another question.
Hi, thank you very much for coming. My question is more related to the chart which you showed before. The chart was due to the state, and the question is following. Do you think that areas of low foreclosure could be influenced by the area of high foreclosures, which could influence the possibility of foreclosure increase and price value itself? Thank you so much.
Okay, thanks. So I think you're referring to the sort of blood-stained map. Yes. So the issue you're raising is I emphasize that foreclosures can affect neighboring prices, and I think what you're raising is a valid point, which is that first of all prices then affect foreclosures, so you get a spiral perhaps. And it may also be that foreclosures affect foreclosures directly. If, for example, there are social contagion effects. And people have begun to research this. There is some evidence that may be going on. This research that identifies spillover effects, though, is always very difficult, because it's extremely challenging to disentangle a true spillover from a common unobserved cause. So this is one of the fundamental problems of empirical social science is doing that. And almost always there's some ambiguity about whether you've identified a true spillover or whether there's some common cause that you're missing. I think there is some evidence of spillovers directly from foreclosures to foreclosures, but it's weak.
There is a question on that.
I have a short question about mortgage innovation slide. Could you be a little bit more specific about inflation index variance? Because it's a little bit confusing how it can be inflation indexed and fixed at the same time.
Oh, great.
Because in Russia it's half possible.
Okay, so let me go back to that slide and whoops. Did I? Well, I may have messed it up. Okay, it doesn't matter. Okay, so my last slide had three innovations that I was talking about, and Sergey rightfully pointed out that two of them require infrastructure that may not yet exist in Russia. So one of them was an inflation-indexed mortgage. You just have to keep going to the end. Sorry. Sorry, you got to go all the way. You're almost there. Almost there. One more. There we go. Okay. So in terms of infrastructure requirements, these you need to have house price indexes, and there's a technology involved in that. Bob Schiller has been developing that for the US, but that's an issue. For these, you need a price index, a credible consumer price index, and that also is both a technological issue and a political issue. I mean, we know in Argentina, for example, that the government is flagrantly manipulating the price index. This, though, by the way, doesn't require any technology, any infrastructure. Now, then your question was, what does it mean to have an inflation index fixed rate mortgage? Well, what it means is that both the principal value of the mortgage, the principal, the debt, the face value, and the payments that you make each month are going to be scaled up over time according to the growth in the price index since the mortgage was issued. So let's suppose you borrow, I'll do it in dollars suppose you borrow $100,000 and your mortgage interest rate is, let's say, 4%. So that means each year you have to pay $4,000 plus whatever principal you're repaying. Now, if it's inflation indexed, and we have inflation over the next year of, let's say, 10%, then we adjust the principal balance from $100,000 to $110,000. It's unchanged in real terms. Similarly, we adjust the required interest. The interest payment is now calculated on the new principal. It's 4% of 110. So instead of paying $4,000, we pay $4,400. Now that's going up in nominal terms, but in inflation index terms, it's constant. So the real value of the payment I have to make is unchanged. And if my salary, let's say, is going up with inflation too, then I'm still able to afford the higher payments. Everything adjusts to inflation. And I'm protected against any real variation in the burden of my debt. That means I won't win if inflation goes up, but equally I won't lose if the opposite happens and we get deflation.
Okay, last question, and then we'll have time to talk probably informally during the reception.
Thank you very much for a very interesting presentation. I have a question about current monetary policy in the United States. What do you think about all these unconventional policies like operational twists, where the Federal Reserve is actually supporting the mortgage market by buying all these securities? So is it for good, or does it make any sense to continue this policy? Thank you very much.
Okay, well, what do I think about unconventional monetary policy? That's a very big question. I think that in an environment where the short-term interest rate has gone to zero, conventional monetary policy involves swapping bank reserves for treasury bills. But if they both pay zero, that's pointless. That achieves nothing. So the Fed then, in order to affect the economy in any way, it has to exchange bank reserves for something else. And at the moment, it's primarily concentrating on longer-term treasury bonds and buying those as a way to drive down yields and hopefully stimulate the economy. In the immediate aftermath of the financial crisis, it also bought mortgage-backed securities and other privately issued securities. Now, then the question is, what does this do? I think it can have some effects. The magnitude of those effects depends on, there's a sort of what in English is called a catch-22. I don't know if you know that phrase, catch-22. It means a sort of ironic trap. So the point is this: the policy is going to be most effective when markets are disrupted and segmented, because then you'll essentially demand curves for assets slope down, and by buying assets you'll be able to drive up their price. But the catch-22, the irony is that in that situation you're only going to be able to affect the market for the asset you're buying, not other markets. Why? Because markets are segmented. So the first round of quantitative easing, which was done immediately after the financial crisis, seemed to be quite effective at moving the prices of whatever it was the Fed was buying. But that's all it did. The effects didn't spill over. Now, in the present environment, when markets have normalized to a large degree, the Fed's having a harder job moving the price of any particular asset because capital is flowing between all these markets to arbitrage. So, the catch-22 of unconventional monetary policy is that you can only have the local effect when the local effect isn't global. And to get a global effect really is quite hard. Now, I think the Fed still has to try it. I don't know what else it can do. But it's not certainly a silver bullet for fixing the economy.
Okay, on this optimistic note, let us thank again John for this fascinating lecture and Q&A session, and we'll have some time in the reception downstairs so you can informally ask John for some other about some other issues. Thank you very much.